begin. Welcome everyone, and from the chair I'll confirm the agenda. Are there any other late items that anyone wishes to note? If not, the agenda's confirmed. Just note that via Zoom we have Miles O'Connor, who's Manager Corporate Services at Bancorp, who will be in attendance for the financial risks update. Firstly, apologies from Councillors Pottinger and Reverend Cook.
Move.
Seconded.
Thank you, Darren. Thank you, Leslie. All those in favour, please say aye.
Aye.
Aye. Against, abstentions carried. Thank you. Declarations of interest will be noted in the Council's interest register. If we move to the minutes of the meeting of 15th of August.
I'll move those.
Thank you, Leslie.
Seconded.
Thank you, Tom. All those in, assuming there are nothing to arise and no matters of correction. All those in favour, please say aye.
Aye. Aye.
Against, abstentions carried. Thank you. Financial risks update. Jamie, welcome. Thank you for your paper.
Cool. Yeah, so I'll take the paper as read. Just highlighting a couple of things. So core debt is highlighted in the report as 114 million. We do have 37 million linked other borrowings as well, which we're taking out for advances and for other investments, which we repaid when the loans are actually maturing. We also entered a couple swaps also over the last, in September. They are future starting swaps, and we got them at pretty good percentage rates compared to our long-term plan assumption, which was 4.5%. 3.4 and 3.3 is pretty good going. In the report, you will also see this has actually changed a bit of our profile as well. So on page 11, I think it is, or page 2 of the report, we've got two graphs that are side by side showing the previous report and the current report. So the previous report we were very close to the bottom bands, whereas now we're quite a wee way above it. But we've done that because of future borrowings, which is over on the next page. You'll see we have a debt estimate for going forward. This is based on 80% of our borrowings in the LTP, less Three Waters because of the uncertainty about the Three Waters swaps and borrowings conversion. So we are still got a wee breach out further, but again, that's a future breach which we'll monitor as we go forward. Also would like to welcome Miles, and if Miles has any comments he would like to present to the committee.
Yeah, thank you. We'll take any comments from Miles first, and then we'll open it for questions. Miles, welcome.
Thank you. Can you see me or just hear me?
See you.
Oh,
See
both,
you.
Miles.
Both.
You're looking strapping.
I just wasn't sure. Thanks. Anyway, thank you for having me to present to the committee this afternoon. Sorry. Look, as far as the report goes, would you like me just to give you a brief update? This was as at 30 September. I presume that you've read the report, but I can update things that have maybe just the important points that have happened over the last month or so. Would that be useful for a few minutes?
Yes, it would. Look, I think we've had your report and we've all had the time to read it and digest it. So forward looking, and then questions.
Okay, so just the one brief thing I will say is, looking back, is that in May the Reserve Bank surprised everybody a little bit when they were so what we call hawkish. They gave an indication that rates may well rise. Their forecasting predicted assigned a 60% probability to the next move of the OCR being a 25-point rise. This was back in May, which surprised everybody given the state of the economy. Then in July, in the monetary policy review, while they kept the cash rate at 5.5, they did a bit of a pivot and more or less indicated that the rate rises, they weren't considering further rate rises and that they may look to ease monetary policy when conditions were appropriate. And the one important point in May is that they projected the first cut in the OCR in the fourth quarter of 2025, not 2024, 2025. Then in August, they had that sort of pivot in July. Then in August, they turned around and cut the OCR by 25 basis points. So they went from predicting the first cut in fourth quarter 2024 to actually cutting the first cut in the fourth quarter of 2025 to actually cutting in the third quarter of 2024. So a big turnaround. And I followed that up, which is subsequent to the report, with a 50 basis point cut to take the OCR to 475. So we've already had 75 points of cuts. Now the markets, and since then, since they cut, we've had confirmation that the inflation rate has come down to 2.2%. It was 3.3. So the Reserve Bank are tasked with keeping it between 1 and 3%, and they want to get to the middle of the band while we're at 2.2. So it was a big fall, although one thing you need to note is that September is traditionally a high quarter for inflation, and ironically, one of the reasons for it is that it captures the increase in local government rates, which take effect from 1 July. So, but the 1.8 dropped out, and I think we came in, and it came in way below that because September 23 dropped out, and that's how we got to 2.2%. And we also had confirmation, at the end of September, as we said, that GDP is now back in the negative. If we get another, that's for the June quarter. When we get the September quarter data out in December, if that's another negative, then we're back in recession. So that will mean a triple dip recession, which I'm not even sure if we had one in the global financial crisis, but it went in and out of recession 3 times. Rates have actually gone up quite a bit in the US. They have in New Zealand since the end of the quarter, and that's because in the US they've had some better economic data, and it's just as far as GDP growth, economic growth goes, inflation being a little bit higher, and the number of new jobs created has far exceeded expectations. So it's actually, the markets are dialing back expectations for cuts in the federal funds rate, which is their OCR, the equivalent of our OCR, and it's led to an increase in our rates, but we haven't got up to the same extent. We're in a slightly different position as far as economic data goes, and at the moment, while the economic data is bad, and I don't think it's going to get too much better for the rest of the year, and I think we will be in recession for the September quarter, there are some quite positive indicators for 2025 as far as a rebound in economic activity goes, and a lot of that is to do with the cuts in the official cash rate that have occurred in August and October. The Reserve Bank look at some key indicators. There's ones like retail sales, job ads, heavy truck index, domestic takeoff weights at Auckland Airport. They see them as key sort of economic, the strength of the economy, and the projections are that they will track up, but it's not the here and the now. I mean, we've got higher unemployment, we've got weakening retail sales and the value of retail sales, and the possibility of a third of the triple dip recession, as I said. But on the flip side, the good news is that inflation is coming down, and that's what's enabled the Reserve Bank to cut the cash rate and continue to cut the cash rate. The markets are projecting the cash rate to fall again, another 50-point cut in November, which I wouldn't be surprised at all about. And one thing I've got to remember about the November meeting is that normally the cash rate is reviewed once every 6 weeks, but it's nearly a 3-month. It's actually an 82-day gap between November and February. They have a meeting over Christmas, so they won't get another chance to cut it for nearly 3 months. And I think as a sort of an insurance policy, they'll go 50 points. Some are even calling for 75 points. I don't think they will be that drastic. But the terminal rate that the markets are projecting is around about 3%. So that's the that's the economic rundown as far as where things are and where we think, they might be going. Are there any questions on that?
Ria?
Thank you very much for your brief there. Just wanted to quiz you further on the comment that you just made that you don't think they'll go to a 0.75 OCR cut. They won't be that drastic. Are there further compounding reasons as to why they wouldn't go that far, given the public pressure that's been put on them to do so?
Well, 75 is very unusual. That's sort of more reserved for, what I think, would be if the economy was in a more depressed state and was requiring more drastic action. Yeah, that's sort of referred to as, maybe an emergency cut, one of that extent. 50 is slightly unusual. Normally the OCR goes, they move in 25-point increments. They've done 150s in the past, and that was in the GFC. But I don't know if they would go to a 75-point cut. The only real piece of economic data of significance that we'll have out before then is the unemployment rate for the September quarter. And that's projected to go up, but if it was a shocker, then maybe it would induce them to do that, or if they had some sort of indication of forward activity, which was especially depressed. But supposedly they go on current data.
Right. Well, thank you.
Thanks, Grant.
Yeah, thanks, Chair, and thanks for your report. Just interested in terms of, as a borrower, which we are, the impact of those reductions and where, the sweet spot would be to try and target around our average cost of funding, do you think, for our forecasts?
Okay.
So when you're looking at sort of what's happening both on the floating predictions or with cash rate coming down, but then you're looking at the yield curve ahead, which always adjusts in a different way, what would you think would be a reasonable average cost of funding for us to allocate into our forecasts?
Okay, just one point I will make, that Jamie said earlier, those two swaps that you did, one was at 3.33, the rate for that now is 3.53, and the other one we did was 3.47, the rate for that is now 3.78. We nearly got the very low in the market, maybe 20 million each, so they were pretty significant.
Yeah.
So given you quite a degree of future proofing, with 40 million out of 114 million of debt, although they are forward starting swaps.
Yeah.
And the other point is that your cost of funds actually isn't projected to go down that much more compared to other councils, and unfortunately there's actually a very good reason for it, is that to our knowledge you have the lowest cost of funds of any local authority in New Zealand. There may be some who we advise about half the local authorities in the country, and you're well below the next highest, the next lowest. I'm not even sure if any are in threes. You're at 3.6%, and that's because you have some very low fixed rate bonds and also some very good swaps. And we have future proofed you quite a bit. But probably the telling one is the graph on it's on our page 5. Jamie, the interest rate projection graph?
Yeah, so it'd be page 17.
Of board books. Yeah.
So that shows the projected cost of funds that we've got for you, and as I said, it doesn't actually show much of a decline. But there's just about every other council who are dealing up to have a cost of funds of yours and a projection just like that. The issue that we're grappling with at the moment is that in the last 3 weeks since this report came out, as I said, interest rates have actually gone up quite sharply. And the US 10-year bond has gone up about 40 to 50 points, and the 5-year swap in New Zealand has gone up about 40 points or so. It's put these forward start swaps that we'd be looking to target more cover with up higher, and into the 4s now. As I said, we did get ones in the mid to lowish 3s. But I tend to think that we've gone far enough as far as this upward movement goes. It's because of US data.
Yeah.
And I would still be looking to target swaps sort of below 375 now as being appropriate. because what the markets will do is they will push rates up prior to the end of the easing cycle.
Yeah.
They've preempted the easing cycle, which has given us some of these forward start swaps, because we're only 2 cuts into it, and the projections are for it to fall to sort of 3.25%. But the markets will turn the yield curve round before that. They already have, but I think they've gone a wee bit too far. So I think we've got to look at about 375-ish.
Okay, thank you. Just if I may, just a couple of sort of, one, US elections, and then secondly, just see that there's a development in the Ukrainian war around North Korea potentially being involved. So those two sort of geopolitical events, how much are they priced into those forward-looking yield curves in your view?
Not an awful lot, really, I don't think. Elections, they can have an immediate effect on rates, and I think when Trump was elected last time, right, the US 10-year went up nearly 1%. But I think if you look at the respective economic policies of the two candidates, Trump's policies are probably more likely to have an upward influence on interest rates or less of a downward influence on interest rates than Kamala Harris's, because he is forecasting increasing tariffs, which will actually put the cost of goods up, because it will replace lower priced Chinese goods with higher priced American made goods. And he's going to cut taxes, for the higher income and the corporations, which will push the deficit up as well, and more spending. So that's probably less interest rate friendly. As far as the North Korea goes, I don't think that's not going to have an effect on interest rates. What would happen, what would have more of an effect on interest rates, is if there was some significant escalation in the war in either Iran or the Middle East. If there was the thought of a nuclear weapon or a significant escalation, then that would push interest rates down, actually.
Yeah.
A lot of people that it pushes interest rates up, when there's global uncertainty. Well, it's actually the opposite, because what investors tend to do is sell equities and buy bonds, because bonds are seen as a safe haven investment, less of a risk. So it actually pushes interest rates down. So that would be the effect of the two possible occurrences on a geopolitical basis.
Yeah, thank you.
Any further questions? There would appear not. Miles, thank you very much for your time and report. It's actually very good to have you present and present and can answer questions directly.
No, my pleasure. I mean, next time, if it's a possibility, I'll see if I can come down and present in person. It's always good to meet you in person sometimes. So if it works out, then I'm happy to do that.
Excellent. That would be good. We have 2 resolutions. I propose that we take them together. Someone please.
Move the 2 recommendations.
Yeah,
Thank you,
I'm
Darren.
second.
Thank you, Grant. All those in favour, please say aye.
Aye.
Against, abstentions carried. Thank you very much.
Thank you.
Thank you, Miles. If we could move to long-term plan delivery process and review. Yeah. Welcome back to this committee. We haven't seen you for a while.
Kia ora, Chair.
Again, we'll take your paper as read. If there are any further comments you wish to make.
I think only to summarise that on balance it was a really successful long-term plan process in terms of hitting the milestones and strategic requirements of Council. Unqualified audit. There are of course opportunities for improvement, and those are identified within the report, as well as potential areas of focus for next time around and how we are intending to respond to those in the planning cycle. Happy to take any questions.
Thank you. Open for discussion. Darren.
Happy to move the reports received, Chair. And in that, thanks for the process, first of all. The review of it shows that there were no major flags, but that we maintain a watching brief to see what we can do better. And it's tinkering at this point, given that there were no major points that we were going out and consulting over. Well, major in comparison to some of the ones we've had in previous LTPs.
Happy to second that.
Thank you. So I can take this process has been a lot smoother than the past.
I like the words unqualified.
Exactly.
Good word.
Right, thank you
Unlike going to the doctor.
for the dentist, Darren. If there are no, sorry, Grant.
Yeah, just a question, if, could Chair, page 4 or 5 of the report, or 24 of board box around the financial system, the Tech One system continues to integrate in, and there are some challenges around the data accessibility and getting information out of that in a timely manner. Can we get a bit more colour on that? It's probably not a question for you, Rhiannon. It might be Patricia or Michael or someone, or Jamie.
I'll take that one, Chief. We implement, the system works from the mechanics point of view. What we're talking about transparency is getting better reporting
Okay,
for those managers that are doing their budgets at a higher level.
okay.
They have got the granular level detail, but they don't have those upward views, which we are working on developing those.
Right, okay. So it's not giving us any sort of surprises around, oh, we thought the number was this and it's actually that. It's more just around the,
It's around the understanding.
just getting better information. isn't it?
Better, it's
Okay.
collating it. I think Jamie's going to tell me how many cost centres we're running. It's several thousand. At granular level, it's detailed,
Yes.
and it's getting that view
Yeah,
up to make
fair
it
enough.
easier.
Yeah, okay, thank you.
All right. We have a mover and second, Darren and Leslie. If there's no further discussion, I'll put the motion. All those in favour, please say aye.
Aye.